Không học thì tôi cho ao thôi. Tôi để tên làm gì? Bạn Hải Nam. Nguyễn Hải Nam. Now answer question. Is an accountant a financial manager?
I'm sorry, I can answer this question.
Why? Now, who is financial manager?
Financial manager is a person responsible for supervision and handling the financial affairs of an organization. They known as the CEO.
So, based on the definitions of financial managers, you can answer the question, is an accountant of financial managers? Thank you. Another. Bạn Thái Thu Trang.
Em thưa cô là manager is chief financial officer and include treasurer and controller. Treasurer is responsible for cash management, raising capital, and banking relationship. Controller is responsible for preparation of financial statement, accounting, and taxes.
And the question, the first question, an accountant of financial managers.
Em không nghe rõ, cô nói lại đúng không?
Is an accountant of financial managers.
Accountant financial manager phải không ạ?
Is an accountant or financial manager?
I think yes.
Why?
Because they have they have to do the work like an accountant, such as they have to prepare the financial statements, and also they have to manage the cash and capital in the corporation.
Thank you. Thank you. As you know that the financial managers is any any individual who is in charge of planning, directing, monitoring, organizing, and controlling the monetary resources of an organization. So, as you know, an accountant is a person who is an accountant. In order to answer whether an accountant is a financial manager or not, you should know the definitions of financial manager as well as the definitions of an accountant as well. In order to compare two definitions with each other in order to find out the answer. Okay. So as you know, an accountant is a person who is in charge of what? Nào bạn Khánh Huyền.
Huyền nào cô?
Khánh Huyền, Phạm Khánh Huyền. Phạm Khánh Huyền đâu?
Nói em ạ. Ôi, không nói em ạ.
Okay. Now, who is an accountant? Đây lại kiểm tra bài của cái kỳ trước. Who is an accountant?
Accountants.
Nào rồi Nhung. Có phải Nhung giơ tay không?
Dạ em có ạ, nhưng mà em giơ tay là who is financial manager.
Thế à? Rồi.
Dạ.
Nào Khánh Huyền. Đặng hay Khánh Huyền?
Em xin trả lời câu hỏi trước của cô ạ. Thì em nghĩ là em trả lời câu hỏi là không ạ.
An accountant is not a financial manager, gì?
Because I think accountants just record the financial information such as financial reports or budgets and tax returns.
So that's the reason why. But
Yes.
You know who is an accountant? Can you answer a question who an accountant is? Bạn nào vừa gọi nhỉ?
Em trả lời câu hỏi của em ạ.
Ai đó?
Phạm. An accountant is a person who records business transactions on behalf of an organization, reports on a company performance.
What is accounting? What is accounting?
Accounting is analyze, audit, and financial statement.
No. What is an accounting?
Accounting, which is often is a process of measuring, processing, and sharing financial and other information about businesses.
Now, what is an accounting that I have given you? How can you define accounting based on what I have taught you? Không phải tìm trên Google đâu. Cô giải hết tôi rồi đúng không? Nào, Ký Đình Nga. Ký Đình Nga.
Dạ vâng em đây ạ.
Who is an accountant?
Vâng, cũng quên rồi.
Hay nhỉ? Vừa thi xong rồi đúng không?
Dạ vâng ạ.
Học kiểu gì mà hay thế? Như các bạn quên như làm sao các bạn trả lời được cái câu hỏi này? Thôi, để các bạn tự nghĩ tự trả lời. Tôi không trả lời câu này cho các bạn. Nào chuyển sang là gì? The rules of financial managers. Now, as you know that the financial manager is any person or any individual who is in charge of planning, directing, monitoring, organizing, and controlling the monetary resources of an organization. That's the reason why they have several roles. And what are the roles of the financial managers? What are the roles of financial managers? Nào Quang Thành. Trần Quang Thành, Quang Thành đây.
There are two roles of a financial manager. The first one is to consult and decide how to maximize the asset value of shareholders. The second is to have much knowledge about different fields such as financial market, banking, accounting, taxation, economic, financial laws. The third one is understand economic policies of nation to give out appropriate forecasts for the assessment of financial policies effectiveness. The last one is face three basic problems concerned with investment decision, financing decision, and dividend decision.
Thank you. But why do they have this role? As you know, the first role of financial manager is that the financial manager has to conjunct and decide how to maximize the asset value of shareholder. And as you know, the financial manager is hired by the boss of the stockholders. Okay. That's the reason why the managers are different from the stockholders or from the owners of the company. And the owners hire the manager in order to maximize the values of the corporate. That's the reason why the financial manager have to conjunct and decide how to maximize the asset value of the corporate values of the business or the asset values of the shareholder. And in order to maximize the asset values of shareholder, they must have much knowledge about different fields such as financial markets, banking, accounting, taxation, economics, financial law in order to make the right decisions at the right time and in the right place. And of course, in order to maximize the asset values of shareholder, they also have to understand the economic policies of nations to give out appropriate focus for the assessments of financial policies effectiveness. And of course, still, they also have to face three basic problems concerned with the corporate finance decision, such as the investment decision, financing decisions, dividends decision, as well as the working capital decision. Okay, so how to face the investment decision? the problems concerned with the investment decision. As you know that the investment decision is a process of planning and management of long-term investments of an organization. In other words, investment decision is one of the important term financial corporate finance decision. And this is one they have to decide how much money should the firm invest in the long term. And the financial managers also have to always consider the time values of money and the risk factors, because the analysis and assessment is to select financial decision in the future. And you know that the financial decision, in order to select the financial decision in the future, or the financial structures of the company, in order to maximize the values of the corporation, they have to come to the second decision. It is a financial decision. You know that the financial decision is the financial manager have to decide how to raise the money to pay for the investment in the real estate. How you can raise the money by two ways. The first, the debt funding, on the financing, equity funding. And how is the debt funding and equity funding you have learned in the first time. And in the financial decision, the financial manager have to use the financial reports and financial ratio, describe cash flow methods to account for the time values of money to prevent the risk in the future. And these, the how to use the financial reports as well as the financial ratio, and how to use the discount the cash flow methods to account the time values of money, you will study in the next chapter. So, how important is the financial managers? Well, as you know, the financial manager is the person who takes responsibilities in managing the finance in an organization, including studying, analyzing, and processing problems belong to financing in the business. This is why they also have to develop plans about finance, exploit, and use the financial resources in an effective way, focus the risk for his business. And he also has to control the use of assets in the companies in order to avoid using wrongly or wastely. And for the dividends decision, they only have based on the financing decision as well as the investment decision. They can decide whether to distribute the dividends to the shareholders or not, or to retain the profits in order to invest in the potential projects or not. So in this, we also have to the distinguishes between the chief accountant and the chief financial officer, and this will learn yourself. And so, as you know, the roles of financial managers, they have to first The three important decisions, they are the investment decision, financing decision, and dividend decision in order to maximize the value for the corporations. And next, the next important contents of this chapter is to understanding the financial market and financial institution. The first, you learn the financial market. Now, what is the financial market? Bạn Uyên Vi.
Yes. Financial markets are the markets for sale and purchase of stocks, for example, shares, bonds, bills of exchange, commodities, futures and options, foreign currency, which works as the exchange for capital and credit.
Okay. Financial markets are the markets for sale and purchases of stocks, bonds, bills of exchange, commodities, futures and options, foreign currency, etc., which works as exchange for capitals and credit. In other words, financial market is a place where the investor or people can buy and sell the stocks, bonds, bills of exchange, commodities, futures and options, foreign currency, etc., in the open market. And as you know, based on the different features, we can distinguish the financial market into different types. The first, based on the durations of the capital. Based on the durations of the capital, the financial market can divide into money market and capital market. And capital market. Now, what is the capital market? Bạn Đoàn Hương Giang. Đoàn Thị Hương Giang. Hà Thị Ngọc Mai.
Có. A financial market that works as a conduit for demands and supply of debt and equity capital. It channels the money provided by savers and depository institution to borrower and investor through a variety of financial instruments, bonds, notes, shares, core securities.
Yeah. Thank you. Financial market. Capital market is one kind of financial market that works as a conduit for demand and supplies of debt and equity capital. And as you know that the channel capital market is the place which channel the money provided by saver or by the people who have a surplus of money to the person who have a shortage of money. In other words, it channels the money provided by saver and depository institutions to borrowers and investors through varieties of financial instruments, such as bond, notes, and share. And all of these valuable notes here called the securities. So based on this definition, you can know that the capital market is a highly decentralized system made up of three major parts. The first, the stock market, the bond market, and the money market. And it also works as an exchange for trading existing claim on capital in the forms of share. And the second is money market. What is the money market? Bạn Nguyễn Thu Trang. Nguyễn Thu Trang. Những bạn mà cô gọi lần thứ 3 mà không được cô cho out luôn đấy nhá.
Em thưa cô ạ. Money markets also trade in highly liquid financial instruments with maturities less than 90 days to 1 year, and government securities with maturity less than 3 years, foreign exchange and billing.
Yeah. So, money markets is also one kind of financial market, which trade in highly liquid financial instrument with the maturity less than 90 days to 1 year, and the government security with maturity less than 3 years, and foreign exchange and bullion. Another was the capital market is a place who trade the long-term financial instruments, and money market is a place who trade the short-term financial instruments. And based on the issuance of the products of capital, financial market also divide into two types. It is a primary market and secondary market. And primary market is a part of the capital market that deal with the issuing new securities. And it is a part of capital market and a financial market that deal with issuing new securities on exchange for companies, governments, and other groups to obtain financing through the debt-based or equity-based securities. And primary market are facilitated by underwriting groups consisting of investment banks that set a beginning price range for given securities and overseas issuance to investor. And the characteristic of the prime market is a market where which can raise the money supply in the market. And the second type of financial market based on the issuance of the product, you can come to the secondary market. And secondary market is a part of the capital market that deal with the securities that are already issued in the primary market. And in this secondary market, they only transfer the ownership from investor to investor. And of course, there's no effect on the company. And there's no effect on the money supply in the economy. So that's the reason why you should pay attention to the importance to understand the distinction between the secondary market and the primary market. And what's the difference between the secondary market and the primary market? You will do it yourself as your homework. And based on the ownership of the product, based on the ownership of the product, you have the equity market and debt market. Financial when divided into the equity market and debt market. And what is the equity market? You know, equity market is a market in which shares of companies are issued and traded either through the exchanges of the over-the-counter market and the exchange market. And the equity market gives the companies access to company to grow their business and investor a piece of ownership in the company with the potential to realize gain in their investments based on the company's future performance. And the security traded in the equity market can either be public stocks, which are listed on the stock exchange, or on the over-the-counter market. But the debt market or bond market is a market in which the investments in loans are bought and sold, and there is no single physical exchange for bond, and transactions are most made between brokers or large investments and institutions. Yeah, that is the financial market and the different types of financial market. And come to the financial institution. And financial institution is a private or public organization that acts as the channel between savers and borrowers of funds, between the suppliers and consumers of capital. So, look at this. Based on the financial institution, you can have two basic flows of funds through the financial sector. It is a direct finance and indirect finance that I have already introduced to you last time. Yeah. And it is based on the indirect finance. The lenders and the borrower had to find out the financial intermediaries in order to borrow and to make loans their money. And based on the direct finance, the lender can sell their financial instruments in the financial market, and the borrowers will buy the financial instrument in order to raise their capital. So the financial institution have two types: the private or the public organization that acts as a channel between the saver and borrowers of funds. So, financial markets perform the essential economic function of channeling funds from household, firms, governments that have a surplus fund to the person or organization or firms or government who have a shortage of fund. And the last The last content we study in this chapter is the goal of the corporation. As you know, the corporation have two main goals. The first, they want to maximize the profits. And of course, they also have to maximize the growth for the business or the values of the corporation. Not only maximize the profits, but also maximize the values of the corporation. But as you know, in order to meet these two goals of the corporation, they still have some problem or conflict between the shareholders and the managers. As you know, because the shareholder want managers to maximize the market value. And as you know, the shareholder is the owners of the company. So of course, they want to maximize the market values by any way. That's the reason why they want the managers to maximize the market value. But as you know, there's the conflict between the managers and the shareholder in maximizing the market value. That's the reason why we, based on the ethics and the management objective, and as the based on the real interest of the financial managers. That's why there are three main goals of the corporation. The first, the shareholder want managers to maximize the market value. And as you know, the profit maximization is not a well-defined corporate objective. They have to increase the current profits by cutting back on the maintenance or stock training. Or they can increase the future profits by cutting this year's dividends and investing the freedom cash in the firm. And they also have the different accountants who may calculate the profits in different ways. And when they want to maximize the market value, they can do by different ways. But the firm's only ways is to increase its market share by reducing the prices of capture new customers, resulting from the fight difficult to borrow money, and they don't have a sufficient profits to replace existing debts, and they have to mobilize capital from outside investors who could offer to buy the firms from its current shareholder. So this is the problem for the shareholder when they want to maximize the market value of the corporations by any ways. And based on the ethics and management's objective, you can know that there's a conflict between the stockholders and the managers. The stockholder to maximize the market value, but the managers not only want to maximize the market value, but they also want to increase the firm value in order to reach both managers and stockholders. And the objective of the firm is to maximize the shareholder wealth, which doesn't mean the firm can do anything because it relates to the unwritten and implicit rules are in general interest and the firm's reputation. And in the long term, the financial needs to in the long term, the financial managers need to build long-term relationship with the customers in order to establish the name for fair dealings and financial integrity. And they also have to emphasize the long histories and responsible behavior when seeking the new customers. And this is the task of the financial manager in order to enrich both the managers as well as the stockholder. But do managers really maximize their firm value? There are two questions, two answers. The manager really maximize the firm value if the managers are also the owners. Why? Why? Because in this case, in this ways, or in this case, the managers and the owners, because they are the same, that's the reason why they don't have a conflict of interest. And the managers are the owners, so they work for themselves. And of course, they want to really maximize the firm value. And the first, reap the rewards of the good work. Of course, they will be awarded if they do the business well or make the business profitability. And of course, they also have to suffer the penalties from the bad work of the management. But when the managers are not the owners, the answer here, the manager don't really want to maximize the firm value because first, because they have an interest conflict. And the separation between ownership and the management may create a potential conflict of interest between owners and managers. And because the shareholders are concerned that managers work for maximize shareholder wealth and not managers' wealth and lifestyle. So the conflict between the managers and the owner here we call the agency problem. And the agency problem occurs when the principal hire an agent to perform some duty, and a conflict known as the agency problems arise when managers, as agents of shareholders, have a conflict the interest with the shareholder. And there are many diverse interests with a stake in the well-being of business managers, workers, suppliers, customer, governments, shareholders, etc. And these stakeholders' interests may conflict at times. Manager must work to resolve these diverse interests. Okay, as you know that the financial reports. There are two types of financial reports. One, the financial accounting and one of the management accounting. That's the reason why the manager have to do with both the financial report. That's the reason why they have to face with a lot of users, and they have to reconcile all the interests of these people in order to make their business have the goodwill. And if not, they come to the percentage plan. Yeah. And these are the different users or the different people that the manager have to face with or have to resolve the diverse interests. They conflict the compensation plan, the board of director, the takeover, the specialist monitoring, okay, and all of them are important in order that the manager have to get on well with them. Yeah. So in short, in the chapter 1, you have to study 6 main content. The first, the overviews of finance, in which we know the definitions of finance and different definitions of sectors of finance, such as the public finance, personal finance, and corporate finance. And in this, we also have to learn the main techniques of financial industry as well as the main sectors of the financial industry. And you know that the main techniques of financial industry is to channel funds from the people who have the surplus fund to the people who have sufficient fund. And based on this type, based on the techniques of financial industry, you can divide the finance into direct finance and indirect finance. And what are the direct finance and indirect finance? You have learned it carefully. And you also learn the business organization and the 3 types of business organization based on the aspects of corporate finance. They are the sole proprietorship, the partnership, and the corporation or the company. And each of them have their own definition as well as the characteristic, the advantages and disadvantages. And next, you learn who is the financial manager. You know that the financial manager is anybody who is in charge of planning, monitoring, controlling the monetary resources of the company. That's the reason why anyone who is in charge of planning, of controlling, of directing, of monitoring, or organizing the monetary resources of the company will become the financial manager. And in the book, they mention the 3 types of financial manager. They are the chief financial officer, the treasurer, and the controller. And next, you learn the roles of financial market and how important is the financial managers. And next, the 5th content, you understanding the financial market and financial institution. And in the financial market, you can know the definitions of the financial market and the different types of financial markets based on the different features, such as based on the duration, on the issuance, and based on the based on the trade method of the product. You can have different types of the financial market. And in the financial institution, you also recall the two basic channel or techniques of the financial market. That is the direct finance and indirect finance. And you learn three goals of the corporation and the conflict of interest between the managers and stockholders. That's all for the chapter 1. Okay. You have 15 minutes break, then we will continue the chapter 2. Chúng ta nghỉ giải lao 15 phút, sau đó chúng ta ra học tiếp.
Em thưa cô.
Nói đi.
Cô em thì em nói không ạ?
Có, nói đi.
Em thưa cô, em là đoàn thị Phương Giang của lớp T2 ạ. Hôm nãy mic của em có vấn đề cho nên là em bật mic cô gọi em bật mic nhưng mà em không nói được ấy ạ. Thì xíu cô có thể cho em trả lời bù không ạ? Bạn này cùng phòng em ạ, em mượn Zoom của bạn này em Zoom em không nói được.
Rồi ok, không sao.
Vâng ạ.
Tại vì bạn ngay từ đầu là tôi hỏi bạn rồi bạn trả lời, cho nên là khi mà tôi gọi rồi bạn trả lời được thì tôi biết chắc là mic có vấn đề, tôi không nói gì nha. Còn nếu không thì tôi đã cho bạn out rồi. Được chưa?
Em cảm ơn cô.
Tôi nghỉ giải lao đi nha. Now, we continue chapter 2, the financial analysis. Now, we continue the chapter 2. It is a financial analysis. In this chapter, we study the following 6 main contents. The first, the overviews of financial analysis. The second, the balance sheet, the income statements, the cash flow statements, and the taxes. And the sixth is in financial ratio. Come to the first main content. It is overviews of financial analysis. Now, what is a financial analysis? Bạn Quản Đức Tùng. Quản Đức Tùng. Quản Đức Tùng đâu? Nó quay lại lớp học chưa vậy? Bạn Nguyễn Thị Tú Anh.
Có. Financial analysis is the process of the evaluating business, product, budgets, and the other finance related entities to determine their sustainability for the investment.
Now, financial analysis is the process of evaluating the business, projects, budgets, and other finance-related entities to determine their suitability for investment. So that's the reason why the financial analysis refers to an assessment of the viabilities, the stabilities, and profitabilities of business and sub-business or project. It involves common size analysis, ratio analysis, chance analysis, and industry comparative analysis. So it is a base performed by the professional who prepare reports using ratio that make use of information taken from financial statements and other reports. So, what can manager do based on the financial analysis? In other words, how important is the financial analysis? How important is the financial analysis? What can manager do based on the financial analysis? Bạn Tú Anh vừa gọi rồi đúng không? Bạn Huyền My. Đoàn Huyền My. How important is the financial analysis?
The importance of financial analysis is continue or discontinue its main operation or part of its business, make or purchase certain materials in the manufacture of its product, acquire or rent, lease certain machineries and equipment in the production of its goods, issue stocks or negotiate for a bank loan to increase its working capital, make decisions regarding investing or lending capital, and other decisions that allow management to make an informed selection on various alternatives in the conduct of its business.
Yes, thank you. The financial analysis is very important because based on the financial analysis, the managers can continue or discontinue, maintain operations or parts of his business. The second, they can make or purchase certain materials in the manufacturers of each product. The third, they acquire or rent certain machineries and equipment in the productions of each goods, and they can they can make the decisions whether to issue the stocks or negotiate for bank in order to increase its working capital. And they also have to make decisions regarding the investing or lending capital, or in other words, regarding the financial decision. And the last, based on the financial rights, they can make an informed selections on various alternatives in the conduct of each business. Yeah. And as you know, the financial analysis is very important like that. And you continue to the next, the goal of the financial analysis. Chưa xe. Được rồi đúng không? Yeah, what are the goals of the financial analysis? Phạm Thanh Huyền, Phan Thanh Huyền. Phan Thị Thanh Huyền. Phan Thị Thanh Huyền. Nguyễn Thanh Hà. Không có. What are the goals of financial analysis?
Financial analysis often assess the firms include profitability, solvency, liquidity, and stability.
Thank you. The goal of financial analysis is that based on the financial ratio, the financial analysis can assess the firm profitabilities, its abilities to earn income and sustain growth in both short-term and long-term. As the companies decrease the profitabilities is usually based on the income statements which reports on the company's result or operation. And the second, they can assess the firm's solvency. And as you know, the solvency here is the abilities to pay its obligations to creditors and other third parties in the long term. And it also assesses the firm's liquidities. This is also the ability to maintain the positive cash flow while satisfying the intermediate obligation. In other words, the abilities of the company to pay its short-term debts and obligation. And the financial analysis also assess the firm's stabilities, which is the firm's abilities to remain in business in the long run without having to sustain significant losses in the conduct of its business. So they can assess all of these for important activities of the company. And based on this, in order to assess of this, they have to use the financial ratio in order to assess the profitability, solvency, liquidities, and stabilities. You will learn in the 6 main contents of these chapters. And how can the financial analysis analyze the financial position of the company? How can the financial analysis analyze the financial positions of the companies? Bạn Vũ Thanh Thảo.
In the core financial analysis often compare the financial material include the past performance with future performance and comparative performance.
Yeah. Thank you. In order to analyze the financial positions of the company, the financial analysis often compare the financial ratio of the solvency, profitability, growth, etc. based on the first, the past performance, the second is future performance and comparative performance. Based on the past performance, they use the historical figures and data of the same firms, maybe 3 years or 5 years, in order to allow to compare the current performance with the past performance. Now find out whether the company is growing or not. And based on the future performance, the financial analysts use historical figures and certain mathematical and statistical techniques, including the present and future values of the business, in order to remain the main source of error in financial analysis. And in the comparative performance, financial analysts use the financial ratios of many firms, compare the performance among different firms with the same business features, in order to find out which company is doing best. Or in other words, the finance analysts can also use different methods, such as they can use a ratio analysis, percentage analysis. In the ratio analysis, they divide the group account balance taken from the balance sheet and the income statement by another. For example, the returns on equity, returns on assets, returns on owner's equities, and quick ratio, current ratios, profit margin, and so on. And they do a lot of the financial analysis use a lot of ratio analysis. And the second is the percentage analysis. In the percentage analysis, the financial analysts involve reducing a series of figures as a percentage of some base amount, such as group or items can be expressed as a percentage of net income. And as you know, all the profitability ratio will be expressed in the percentage. So the percentage analysis often used to make the returns analysis or percentage, the profitable analysis. And in the percentage analysis, divided into two types. It is the horizontal analysis and vertical analysis. Horizontal analysis analyzes the percentage change in individual financial statements over a period of time. Yeah. It is, on other words, they use or they analyze the percentage change of single item in the financial analysis over periods of time. But vertical analysis analyze the relationship between the items on the financial statements by expressing each item as a percent of the base value compared with the other companies of the different size. And the information that the financial analysis can use to make the financial analysis based on the ratio analysis, or percentage analysis, or based on the past performance or future performance or comparative performance. They have to use and they have to base on the financial statements or financial reports. They are consist of the balance sheet, income statements, and the statements of cash flow, and come to the balance sheet. We find out the balance sheet. What is the balance sheet? What is the balance sheet? Kim Ngân. Kim Ngân cô gọi chưa nhỉ? Kim Ngân.
Em đây ạ.
Cô gọi chưa?
Dạ chưa ạ.
Dạ đó. What is the balance sheet?
The balance sheet is the major financial statement reflecting comprehensively the financial position of a business with total assets, liabilities, and equity at a given point in time.
Thank you. The balance sheet is the measure of financial statements reflecting the comprehensively the financial positions of business with the total assets, liabilities, and equities at a given point in time. And it is show the accounting equation. It is assets equal liabilities plus the owner's equities. The balance of assets is equal to the totals balance of the liabilities and the owner's equities. So, in other words, the balance sheet, also known as a snapshot of the firm's assets and the source of the money that was used to buy those assets. So how can the balance sheet be described? As you know, the balance sheet can be described into two types of forms. It is the horizontal forms and in the vertical form. And look at this. This is the horizontal form. In the horizontal form, the balance sheet is divided into two parts or two columns. One is the assets and one is the liabilities and owner's equities. Okay. In other words, the assets and the balance assets on the left hand and the liabilities and owner's equities on the right hand of the balance sheet. So this kind of balance sheet is in the horizontal forms. And the second is the vertical form. In the vertical form, the assets and the balance of the total assets will be in the beginning of the balance sheet, and the liabilities and owner's equities and their balances will be shown at the end of the balance sheet. So this is a vertical. This form is a vertical balance sheet, and this form is the horizontal balance sheet. And all the items on the balance sheet on both the vertical or horizontal balance sheet are the same. Okay. Ratio in the assets consists of the current assets and long-term or non-current assets. And the liabilities have a current liabilities and long-term liabilities. And owner's equities consist of all the items concerned with the owner's equities, such as the capitals and reserve, shares capital, share premium, treasury stocks, difference in assets, revaluation, foreign exchange difference, funds or undistributed earning. And based on the budget sources and other funds, we have bonus and welfare funds, subsidized not-for-profit fund or financial resources for fixed assets. Okay. And they're the same for both the horizontal and the vertical balance sheet. In other words, and the main balance sheet item consists of the current assets, in which we have cash and securities or cash and equivalent, and receivable and account receivable and inventories. Plus the fixed assets consists of the tangible assets that can be touched and intangible assets that can be touched, such as the trademark, the turn on, and so on. And the total current assets plus the fixed assets equal the total of current liabilities plus long-term liabilities and shareholder equities. And when we study the balance sheet, we should understand the difference between the book value and the market value. And what is the book value? The book value, Ngọc Lan.
The book values is the value of the assets or the total amount of the shareholders' equity, which has recorded on the balances, and book values as based on historical or original values.
Thank you. The book value is the value of the assets or the total amounts of shareholder equities which are recorded on the balance sheet. And the book values are based on the historical or original value. So all the value shown on the book called book value. And there are 3 types of book value. You should know it is the book values of common stocks of a firm and of liabilities. Of common stock. It is the amount that shareholder would receive for each share if the firm's assets were shown. And the book values of firm is the firm's net worth reflected in its balance sheet as owner's equities. And the book values of liabilities is the full amount of liability less sum already paid. So, based on the book recorded, we can know the book values of the common stock of the firm and the liabilities. And as you know, the book values of common stock can be calculated by dividing the book values of firm by the numbers of shares held by the shareholder outstanding share. And but the liabilities it is complicated by the amount of liability less sum already paid. And what about the market value? As your market value measure the current values of assets and liabilities in the open and comparative market. So market value are determined by the current value based on the supply and demand of the market, not based on the book. And now, if you pay attention to the stock exchange Vietnam at the moment, you can see that a lot of companies have the book value is much higher than the market value, and some have the market value is much higher than the book value. So the market value also have the market values of securities or common stock and the market values of business. Market values of securities is the price that the buyers and sellers establish when trading of such share. And market values of business is measured by the market price per share multiplied by the total numbers of shares of an enterprise. For example, if you bought a house 10 years ago for $300,000 and now you can sell it for $500,000. So $300,000 here is the book value, and 500,000 here is the market value. So the market value show the real values at the current on the open and comparative market. And another example, the company have an automobile cost of $22,000. Have already accumulated depreciation on this automobile is $16,000. So the next of those two amounts, we have $6,000. So $6,000 here is the book value of an automobile at the moment, because it reports on the company's book. But the market values could be more or less than $6,000. For example, in Vietnam, if it is in Vietnam, for example, a car, for example, the market value could be more than the book value. Okay. But the computer, for example, after depreciation, the market value may be less than the book value, because for the developments of technology now, so the intangible depreciations of the electronics are very less and less valuable. And this is the distinction between the book value and market values in liabilities. As you know, the accounting simply records the amounts of money that you have missed to pay. For the short-term liabilities, this figure is close to the market values of that unit. But for the long-term, market value can be higher or lower than book values, because based on the laws of economics, such as the supply and demand laws, the values, the loss of values, and the comparative value and loss, etc. And based on the laws of economics, we can know whether the market value can be higher or lower than the book value. In other words, the difference between the book value and market values, the shareholder claim is that expressed clearly in the shareholder equities. It measures the cash plus the cash that the company retains, and in principle, it operates effectively and high growth potential. And if the company make a lot of profits, or the company's profitability, more and more profitability, the market value will be higher than the book value, and vice versa. And this is another example. The comparison between the book values and market value. And this is now come on to another financial report. It is an income statement. What is the income statement? Bạn Vũ Linh Chi. Vũ Linh Chi. Bạn Nguyễn Đắc Thảo Vân. Nguyễn Đắc Thảo Vân. Trần Thị Như Ý.
Em thưa cô là the income statement is the company's financial statement that indicates how the revenue is transformed into the net income.
As you know, the income statements are it also have another name. It is a profit and loss statement, earning and expense statement, an operating statement or statements of operation. It have lots of other names. So income statement is a company's financial statement that indicates how the revenues is transformed into the net income. So income statement is a summary of the management's performance as reflected in the profitability of an organization over a certain period. And it itemized the revenues and an expense past that led to the current profits or loss. And it indicates what may be done to improve the result. So the firm cash flow can be quite different from its net income. So look at this. This is a sample of the income statements. Yeah. In the income statement, it shows the revenues and gains, and it also shows the expenses and losses. We take the total revenues and gains minus the total expense and losses. We have a net income. Or in another, the revenue minus the expense, we have a net income too. So net income here is also earning before interest and taxes. EBIT. And a lot of people often misunderstanding between profits and cash flow. So that's why in the when studying the income statement, we have learned how to distinguish between the profits and cash flow. And this shows very clearly in your book. Okay. As you know, the net income or income statement doesn't recognize the capital expenditure as expenses. And this is so in the accounting principle. An income statement uses the actual methods of counting. An accountant don't simply account the cash coming in and cash going out of firm. So the cash payment consists of current expenditures and the capital expenditures we are deducted from the current profits. So look at this. The cash flow equals the sale minus the change in receivable. And the cash outflow equals the cost of goods sold plus the change in inventories. So look at this and remember this in order to find out how to calculate the cash flows and the cash outflow in order to compare with the profits and distinguish between the profits and the cash flow. And the last, the financial statement is statements of cash flow. In the statements of cash flow, we have to answer 3 questions. The first, what is the cash flow statement? And how is cash flow statement different from the other financial statement, as well as what makes up a cash flow statement. And this we'll study next time. I think that's enough for today. So in short, today we have learned 2 main content in the chapter 1. It is the roles of financial managers, the understandings of financial market and institution, and the goal of the corporation. And in the chapter 2, we have learned the overviews of financial analysis, in which we study the methods, the goal of financial analysis, and we study the balance sheet, and the descriptions of the balance sheet, as well as the items in the balance sheet. And we also learn the income statements and the make distinguish between the profits and the cash flow. And okay, and at home you have to make. Nếu tôi yêu cầu các bạn làm gì nhỉ? Quên mất rồi.